And today I'm going to talk about British Decline Redux, draw on some of the themes of the book. And what I really want to sort of talk about is where the British economy is today, quite how bad it is, how it compares to previous episodes of talk of relative economic decline, and the differences. So I'll just start with the really straightforward, it's not looking good. There's really straightforward numbers taken from the IMF's most recent forecasts, which came out not very long ago at all, a few weeks ago, and just looking at average annual growth forecast 2023, 2024, 2025 for the G7. Just going 3 years forward, as that's the standard medium-term forecast period the Bank of England would talk about, or the OBR, using the IMF because it's timely and it's cross-national. And yeah, I mean, it sort of speaks for itself. I mean, it's not a disastrous performance. It's only a little behind Italy and France, but the UK, as the quick take said straight afterwards, is forecast to have the weakest growth over the coming 3 years. We should add to that if we looked at consensus forecasts, the company that collate private sector forecasts, they say the UK is going to have the deepest recession this year of any G7 country, deepest in Western Europe, slowest recovery. We could go further. We could say that the UK is the only G7 country where GDP never regained the pre-pandemic peak. I mean, there are many different ways of cutting this, but we're saying that the UK has experienced a slower recovery from the pandemic than our international peers. It's expected to have a weaker performance and a deeper recession this year, and then a slower recovery afterwards. In other words, post 2020 pandemic COVID hit to the UK has been harder than in many peers. And of course, things haven't been looking good for a while. This is my favorite sort of rough and quick measure of how the UK economy is doing over the medium term, which I mean, since 2008. Just UK GDP to US GDP per capita, again, IMF numbers, purchasing power parity. And the broad story is if you go back 15 years, UK output per head is about 4/5 of US levels. It's now closer to 3/4. And that is a noticeable slippage over 15 years. The stat I always quite like on this is if you look at the 10 years before the financial crisis, UK per capita output growth was the second fastest in the G7, behind only the United States. In the 10 years afterwards, it was the second slowest in the G7, ahead of only Italy. There has been a period of economic convergence between Britain and higher productivity countries in the 90s, in the early noughties. And since 2008, we've been in once more of an opening of that gap.
I wonder what happened in 2016.
Yeah, something happened in 2016. Come back to that. But something happened in 2008 as well. And I think that's there are two hits. There are two hits. This runs before 2016. I want to start though by saying, in some ways, decline is nothing new. I mean, you can't read any history of the 20th century British economy without encountering decline quite regularly. I mean, at risk of being slightly flippant, and it's true, but it's also flippant, and I sort of guard against it. But on one level, the economic history of the UK since about 1850 has been a story of relative economic decline. Because, very straightforward, using the Madison Project numbers, the UK went first. Bit of advice, if you ever Google Madison data, Google Madison Data Project. Otherwise, you get lots of hits about the Ashley Madison adultery website hack to look it up, and various strange questions about your Google history. But the Madison data, I'm just looking at 50-year increments, because that's when the comparable data is. 1650 forward to 1850. Just looking at Germany, France, the USA, comparable countries, something happens in Britain. British GDP per head is roughly equivalent to the others in Western Europe in the mid-17th century. By the mid-18th century, it's well ahead. By the mid-19th century, a huge lead has been clawed out. Britain went first. We could talk at length
about the reasons why Britain went first. It's a really interesting debate. I don't have the answers, but in some ways it's irrelevant to the fact it happened. And this had a huge impact on Britain. It allows Britain, which is still population-wise a relatively small country, to have much higher national output, much more power, to seize out this much larger global role than you might expect an island off the coast of far west Eurasia to do. And in 1850, Britain has this incredible lead over other countries in terms of output per head. But I think the thing to remember is, whatever the reasons why it happened, there was no reason that other countries couldn't experience catch-up growth, that this outsized lead would always prove fleeting. And that's why I think it's slightly flippant to talk about decline being nothing new. But it is worth looking at the two periods when decline as a theme really seized, how the British elite, how British policymakers, how British economists thought about their economy. First one was in the late 19th century, very early 20th, the first decline, the first time that people started to worry in Britain that the economy wasn't performing as well as it could. And sort of Victorian debates on economic policy are very different to modern debates. I mean, it's question, the tools of economic policy look very different. The conception of economic policy looks very different. And most importantly, the data that we all take for granted doesn't exist in many cases. GDP is a much later invention. You've got trade statistics, you've got other types of statistics. So it's this policy debate in the very late 19th century, the early 20th century, is not carried out in the context of these later Madison GDP numbers. What we can see from the Madison numbers is, you've got the USA overtaking Britain by roughly the very end of the 19th century, start of the 20th. Germany and France, you've got growing faster than the UK, but still not catching up. I think if you look at just Germany and the UK, British GDP is about twice German GDP in the 1860s. By the 1910s, it's more like, the lead is narrowed. Germany's gone from 50% to about 70% British GDP. There's been faster growth in Germany and France as they've industrialized, faster growth in the United States. But it's unclear to policymakers don't have these numbers. They're reacting to different things. One thing they're particularly reacting to is more and more foreign manufactured goods appearing in British shops. Britain is this unilateral free trader in the 19th century, but it's been sort of easier to be a unilateral free trader when you essentially are the world's manufacturing system. And you start to see pressure on that in the 1890s. Ernst May's book, Made in Germany, which is a complete diatribe. I mean, it is just crazy. It's fun to read, but it's a bestseller that goes through several editions. People are sort of scratching their heads, asking what's gone wrong with the British economy. My absolute favourite thing from this time is a Daily Mail headline from 1900, which is, headlines were longer then, but it is American furniture in British stores, a further indictment of the trade unions. There is this sense that the lead is being lost. You see it when you look at international exhibitions, that they go from being dominated by British manufacturers to there being higher tech, more innovative French, German, Americans. There's a sense that something's gone wrong. We'll come back to that. And then there's the more famous decline. Britain's decline, end of the Second World War, 1950s to the 1970s. The real period of relative decline, which really dominates how policymakers often still think about this. We'll come back to this as an important part of the national story. And there is, the interesting thing is the gap between the UK and the USA actually is fairly constant over the 50s, the 60s and 70s. When we talk about acute British worries about relative economic decline in the post-war period, we're talking about Western Europe, and we're talking about France and Germany catching up by the late 1960s, overtaking. You could add Italy overtaking in the mid-70s as well. And how there is a really active and interesting debate within economic history, within political history in general, in terms of how we should think about this decline. You know, the traditional declinist arguments are that the UK in the post-war period is suffering from the British disease, poor productivity growth. And you know, the symptoms are clear. It's very poor productivity growth, it's weak manufacturing performance, it's lost export markets. The causes depend on where you stand in the political debate. You know, people blame poor industrial relations, over mighty trade unions, a British elite which isn't interested in science. There are many, many explanations. I'm going to come back to this because it's important. The anti-declinist argument has been more in vogue in the last few years. It argues that actually this isn't as dramatic as it looks. It argues that if we go back to 1950, a much higher proportion of the workforce in countries like Germany, France, and Italy was still working in agriculture. And the story of, you know, the British move out of agriculture had already happened, mainly in the 19th century. And all we're seeing in the 50s and 60s is people moving from relatively low productivity jobs to relatively higher productivity jobs in manufacturing or services in Europe, and you're getting that catch-up. I think there's something in that anti-declinist story, although it struggles to explain what happens in the very late 1960s, the 1970s. It can explain a European catch-up, it can't explain that overtaking. And this is, you know, by the 1970s, something which is coming to dominate British politics. It's already there in the 60s. You know, the 60s see all of the different political parties competing on different visions of how to manage the economy. You know, I say somewhere in the book that productivity is not something you ever see on an election poster. You know, politicians think about employment, they think about inflation, things that actually matter to people day to day. The one time that is not true is in the 1960s, because Harold Wilson puts productivity on election posters. The first economist to be prime minister, the first person to try campaigning on productivity. Interesting thing. But you know, there's all of these competing visions of how Britain can reverse its decline, which is happening. This time, though, I really do think it's important to be different. The two previous episodes, it is absolutely important to bear in mind we are talking about relative economic decline. We're talking about other countries growing a bit faster than us year on year. Why I say this time is different, you know, you can't come to an event in Warwick, certainly a Cage event, without having a Nicholas Crafts chart. This is from a paper he did very recently with Terence Mills, looking back at Britain's productivity performance over the last decade and going for really long-run data. This is the 10-year cumulative divergence from trend, 1761 to 2008. Now, the previous periods in which we talk about British declinism are around here, and they are around here. Now, the current place of the UK economy is rather different. If you want to find a slowdown in productivity growth, similar to the one we've experienced since 2008, you've pretty much got to go back to the pre-industrial revolution Britain. And I said before, productivity is not something we often hear in the national economic debate. It's not a first order problem like rising unemployment or soaring prices. It is instead a slower burning problem. The real problem with weak productivity growth is at the time it doesn't feel like the most pressing issue. It's only when you look back over the last 15 years and say, why have we fallen from 4/5 of American income per head to 3/4? And if you ask again in 15 years' time, well, we're going to be on current trends. It's a slow burning crisis which doesn't excite the kind of political energy which, you know, the gyrations of the business cycle tend to. But it has left us with a crisis. I just call this ouch. So I don't know what better way to call it. This is a chart from the Resolution Foundation. They put this out towards the end of last year. They've updated it now. The numbers for this parliament are forecast using the OBR's macro forecasts. I think this is a phenomenal chart. There is so much UK history of the last 50 odd years on this, 60 odd years on this chart. It's just growth across the income distribution by parliament. Starting with the, we drop off the very, very bottom, I can never pronounce the word, but 20th, Vigintal, because the data isn't good enough. And what you see is, you get the picture of the 1980s we're going to talk about with faster growth than in the 60s and 70s, but a very, very different skew in the distribution of it. You get the 90s with actually much broader, much more shared growth, and then you get the last 20 odd years. And yes, this parliament stands out as particularly disastrous, with 19 out of 20 British people likely to be poorer in 2024 than they were in 2019. Something that certainly hasn't happened in the preceding 50 or 60 years. But actually, the whole sort of post-2000 period isn't great. Something has gone wrong. And when we talk about our productivity problem, what it means in practice is the real wage numbers we've got. Going back to some long-run data again, we said, on the previous slide, that our productivity performance, if you want to find a productivity performance this bad relative to trend, you've got to go back 250 years. It's actually the same picture with real wages. Real wages, median real wages in 2025 are expected to be no higher than they were in 2008. 17 years without any real wage growth in aggregate. If you go to the Bank of England's millennium of macroeconomic data spreadsheet, you can get the estimates of price growth, you can get the estimates of nominal earnings growth back to about 1600. If you try and look for another 17-year period without any real wage growth, you've got to go back to the 1650s. Worst productivity performance, 250 years, slowest wage growth, 350 years. I mean, it's not great. This period of relative economic decline, this period of decline, this burst of economic pessimism is deserved. The current performance has been atrocious. Now, what's happening? I mean, if only I knew. If only I knew. Economists tend to call it the productivity puzzle, which is both nice and alliterative, and also is a polite way of saying we don't know, isn't it? You get so many, I often think if someone tells you they've solved the UK's productivity puzzle, you need to tell them to go away and read more, because there are so many different competing answers. The answers that I tend to think about are, okay, I accept the financial crisis is a big part of it. When the financial crisis hit 2008, 2009, there was a lot of work saying that financial crises tend to have a lingering impact on productivity growth. You expect productivity growth to be weaker for 3 or 4, even 5 years after a financial crisis than before. I accept that. And I also accept that although it was a global financial crisis, that finance was very important to the British growth model that then existed, that maybe there are reasons to expect the hit to last longer in the UK than elsewhere. And I'm prepared to accept that as an argument for what was going wrong in 2010, 2011, 2012, 2013. Feels a bit of a stretch to still be blaming that 15 years later. Oil and gas, we'll talk about this a bit later, but I do think the decline of oil and gas production in the UK is something we tend to miss out of the story, but I'm going to come back to that. Sector-specific issues, oh, there are loads. It looks like UK pharmaceuticals and life science got really unlucky, that in the 1980s, the 1990s, the early 2000s, they were having hit after hit after hit. 2008, 2009 onwards, very few major breakthrough drugs being produced in the UK. That sort of thing. Sector by sector, you can find these different issues. Now, I am very suspicious of any explanation for a crisis this severe, which is just, we got really, really unlucky. A lot of different idiosyncratic things went wrong in different sectors that have probably added to it. There's the measurement question, and approximately every 6 or 8 months, someone will put out a paper saying, actually, it's a measurement problem. I'm prepared to accept that loads of these new digital technologies are being poorly monitored, poorly captured by ONS data. I'm very happy to accept that. But two things I'd say would be, or three things I'd say. One, for a measurement issue to explain away what's happened over the last 15 years, it would have to be the most catastrophic miscounting in economic history. Secondly, it would have to explain why British statisticians were much worse at capturing this than other stats agencies around the world. And thirdly, we have to explain why, if actually everything was fine and it was just a measurement issue, why that's not what people in the street seem to think. You know, there is a people are, I think there are many problems saying it's just measurement, which really takes you back to policy. And I think there's a couple of policies. I think the early turn towards deficit reduction in 2010, I think slowed demand growth. I think it slowed economic growth in the early 2010s. I think one way that comes through in the data is in terms of weak productivity growth. I actually think of the recession that we had in 2008-9 and the recession that we had around the time of the pandemic as the first real stress tests of the very, very flexible, liberal labour market created in Britain in the 1980s and the early 1990s. You know, even if you look at the late 80s, if you look at the early 90s recession, you still haven't got a labour market which has fully digested all of the Thatcher changes. You've got then 15 odd years of continuous economic growth, then the crisis. What we saw in the crisis was a British labour market which is now incredibly good at creating jobs, incredibly good at keeping unemployment down, but where there is very hard to see where wage pressure comes from. I think that what you've seen really over the last much, you know, I think we've seen an economy which is weak, but which has a high supply of labour until the pandemic. And where that manifests itself is relatively high employment, despite weak economic growth, low productivity growth, very low wage growth. And of course, the other thing that was mentioned at the beginning, that thing that happened in 2016, Brexit referendum, which we know between 2016 and 2020 led to a very large increase in uncertainty, which led to weaker corporate investment, postponed or cancelled investment. And now we've added trade frictions into a previously frictionless border, which again is at the margins and net negative, you know, accept all of that policy. And I think it's worth throwing in there as well, anti-growth politics, which we can talk about in the questions. But I do think something new, and I'm going to leave this one for questions, but I think something new is, when I look at the political economy of Britain over the last 200 odd years, most of it I can understand. You've got, you know, the rise of industrial capital versus previously landed capital, and the political system changes as the economy rebalances, as landed capital, as capital becomes more important than land. You've got the rise of labour and organised labour in the late 19th century, in the 20th century, growth of the state. You know, this is all classic, different interest groups that I understand pushing against each other. I understand what happened in the 80s in those terms. You get this alliance of people for whom inflation is the primary problem. They push back against labour, which has become overmighty. You get the 1980s. I think in the last 15 or 20 years, the British economy has experienced something quite new, something we certainly hadn't experienced since the Industrial Revolution, the rise of what I almost think of as a post-economic voting bloc. Populations become older. Older people are much more likely to vote than younger people. The people who are much more likely to vote than younger people are disproportionately, but not entirely, homeowners, disproportionately, but not entirely, more secure, either in their pension income or in their expected pension income. And suddenly we've got this big block of voters who are, to an extent, and maybe until this year on the sheer scale of the cost of living shock last year, who are relatively well insulated from the gyrations of the business cycle, from the labour market. And I think it does weird things to your economy when you can win an election despite losing the votes of most people in work, as happened in 2019. Conservative Party. I think that creates weird incentives. And I think, you see it in terms of, attitude to the universities. I'm not just saying that because I'm in a university. In terms of attitudes towards building, infrastructure, all sorts of things.
And business, right?
Yeah, exactly. And it's just worth thinking through the politics. Now, I'm going to say to start with, I'm not going to ask a quiz of who these four people are. They are Joe Chamberlain, David Lloyd George, Tony Benn, and Margaret Thatcher. And I will say, it is surprisingly hard to make a 4-panel picture thing using PowerPoint. So I had to download an app to do it on my phone, which is primarily designed for Instagram. And I came so close to just posting this on Instagram with no response by accidentally clicking the wrong button. Anyway, by the by, that's a peek into the sausage factory. I just think it's interesting when we look at those two previous periods of acute debate on Britain's place in the world. You saw politics on both sides alive with ideas. In the late 19th century, early 20th, you saw Joe Chamberlain proposing Britain abandons free trade, that it throws up protectionist barriers, that it doubles down on the empire as an economic unit, that it introduces more types of German-style social welfare, this sort of rewriting of how the British economy had ran itself for 60 or 70 years. He could see the economy, there is a debate that something has gone wrong in the economy. He had a radical plan to shake up how the economy worked. Lloyd George on the other side, and I could have equally put there Asquith or Campbell Bannerman or a young Winston Churchill. All of these people associated with the early 20th century neoliberalism, they had a competing vision. Birth of a nascent welfare state, progressive income tax, rather than just income taxes, another ideas about how to reorganize the economy. In the 70s, you had on one side, Tony Benn saying, the problem with the British economy is that it is not socialist enough, and we need to double down, and we need an alternative economic strategy, and we need protectionism, and we need to nationalize more industries, and we need more British state-funded research. And on the other side, you have people like Margaret Thatcher, and the think tanks associated with her rise in the 70s, saying, no, the problem is that the British economy is too collectivist, too socialistic. What we need to do is roll back the borders of the state, to privatize things, to cut taxes. But in both cases, the serious economic problems were met with a serious debate amongst the parties. And you had a sense of crisis. This is the famous Sun front page, Crisis for Crisis, which was actually a mischaracterization of what the Prime Minister had said, but it brings out the national mood. And whenever I look at this front page, sort of defining front page of the 1970s, that Britain is in crisis, it's not just the headline that makes it, it's this bit here, which is the Sun apologizing that it's slimmer than usual because of a national shortage of newsprint. The Sun is not inventing this crisis. We are in a world where newspapers are having to print themselves at 2/3 the normal size because there are strikes in print unions, there are blockages at the docks stopping print ink getting in. But there was a sense of crisis. It's a sense of crisis you get when you read pretty much any British newspaper, left or right, from the mid-60s in many ways until the late 70s. This sense that something had gone wrong. Now, I think that has been sadly lacking in the current episode of decline until very, very recently. Now, the last 6 to 12 months, I think this has begun to change. You start to see more and more references, not just in The Economist and the FT, to something going wrong with the British economy, and debates about whether that's Brexit or whether it's not Brexit, or whether it predates Brexit, or what it could be. But it is new. We are not in the first or second year of an economic crisis. We are in the arguably 10th or 15th. The cynic in me, and I try not to be too cynical, but the cynic in me notes that 15 years of stagnant or falling real wages failed to generate a sense of crisis in Britain. 6 or 8 months of interest rates spiking and talk of house prices crashing, suddenly it's a national crisis and we've got to take it seriously. That sense of crisis is now, I think, finally starting to emerge. Before we move towards questions, it's worth thinking about what changed. What changed in the this sense of crisis in the 1970s to this great moderation of the 90s and 2000s. Obviously, the British economic model is radically changed by the 1980s. Sweeping changes, whether it's privatization of utilities and various other companies, whether it's very large reductions in marginal tax rates, a rebalancing of tax as well. A very different economic approach. It's worth thinking through how the last period of relative economic decline was reversed. And I think it's worth thinking about it in terms of three competing stories, which are not mutually exclusive. The first story is the traditional one. This is a Conservative election poster in 1992. Yes, it hurt. Yes, it worked. I don't think they're going to try that next time. It ends with faster growth than Germany, France, and Japan. That was the pitch. The pitch was this painful reform of the British economy was fundamentally worth it. Now, you look at the macroeconomic record, just in terms of the business side of Thatcher government. The 80s don't look amazing. You have a very deep recession in the early 80s, a very deep recession, a less deep, but painful recession in the early 90s. You've got high unemployment throughout the decade, but you do have a turnaround in productivity growth. You do have the end of this period of relative economic decline from roughly 85 or 86, depending on which measure you prefer. The gap between Britain and Western Europe starts to diminish. That you get British convergence back towards the global productivity frontier. And the traditional story that you will be told if you go to the Centre for Policy Studies or the Institute of Economic Affairs or talk to many people in the Conservative Party is this is because of these painful reforms under Margaret Thatcher. The pain was worth it. It's interesting when you see Liz Truss and Kwasi Kwarteng talking, as they did in September, about basically doing this again. The problem I always think with that analysis is that, Thatcherism, the thing about Thatcherism is it's already happened in Britain and it's hard to do it again. If you go to the OECD and, them indices of regulation, if you look at British product market regulation, already one of the lowest in the OECD. If you look at British labour market regulation, already one of the lowest in the OECD. If you track that over time, what you see is they were both very high in the 70s. That regulation was rolled back in the 80s and the 90s. Fine, we can debate the merits of it. What we can't debate is whether or not you can do that again, because you can't. Story number two, though, puts a slightly different spin on it. This is from a guy called Campos at UCL. He's got a very different story. His story is actually, to understand the catch-up in the 80s and 90s, you need to go back to the EEC. That actually what happened, that the real break comes in 1973 with British entry into the European Common Market, European Economic Community, later the European Union. That's what causes decline. And actually what you see in the 80s and 90s is in many ways a EU story. So if you're broad picture, Britain in the 19th century is an incredibly open economy. Very, very, very high trade intensity, very open to imports, very high exporting, but very globalizing and very globalized. 1930s onwards, you see a more inward turn in the British economy, and that really lasts until the 70s. It's only in the 70s, after joining the EEC, that Britain starts to reopen itself to international trade. What this does is it expands the market size for exporters. It exposes domestic firms to more competition. It drives up productivity. I think there's definitely something in this story, and it's a really fun story to tell very, very committed Thatcherites. Because firstly, you get to tell them that actually it's all about the EEC, and secondly, you get to tell them that the person who should be thanking is Ted Heath. Which really, you get some raised eyebrows. I think you could push this too far, but I think the role of European economic community membership in Britain's story of reversing decline is just as important as any domestic policy in the 1980s. And then you've got story number 3, which is one we sort of tend to forget. So you know, if you were to sort of ask someone who knew nothing of British economic history to look back at the last 60 or 70 years of British economic history and say, you know, what are the defining things that happened in the 1980s? I think they would probably say, looking at the numbers, that bit when you became a petrol state for a few years and then stopped being one is probably quite important, and probably more important than it's traditionally given credit for. This is my favourite way of looking at it. It's just revenues from oil and gas as a share of GDP, tax revenues as a share of GDP. You know, when you go from basically no tax revenue to over 3% of your over 3% of GDP in terms of tax revenues in the space of a few years and then drops away again, it's quite a big thing. I mean, I was thinking about how to characterise this with a friend who used to work at the OBR a few weeks ago. And they said, well, you know, in terms of impact on tax share of GDP, that's about 2.5 Brexits as a plus, though. I mean, it is a big thing. And I sometimes think we forget when we talk about the 1980s, you know, we can argue about the impact of the EU. We can argue about the impact of any of those different domestic reforms. We shouldn't forget that we had a temporary bonanza which lasted about a decade and a half. And is obviously impact on productivity quite large. That's why, you know, the ONS now tend to split out non-continental, tend to split out the oil and gas numbers when they're doing productivity numbers going further back, because it distorts the numbers so far. So I've sort of gone through my slides, and I've just finished for a couple of minutes asking, where does this all leave us? I think I've hopefully not been too depressing, but I have been quite depressing. I think I've been depressing to the appropriate amount for what is quite a depressing economic outlook. Looking back, I think that those 2 previous periods of economic decline is really helpful. Because firstly, we can say that the current situation is much worse than anything we had in the 50s, 60s, 70s. It's much worse than what exercised the attentions of late Victorian and Edwardian policymakers around the turn of the 20th century. And yet, despite the outlook being worse, despite the performance of the last 10, 15 years being materially worse in terms of impact on living standards, it feels that it's only in the last year and a half that it's generated anywhere like the sense of crisis and political attention which the 2 previous episodes did. I actually always like to end by being optimistic. I try. Now, I think the best grounds for, you know, we can go back to that slide of what's caused the British productivity crisis. And my honest answer is I don't know. Some combination of all of those things in their own ways. But the best grounds for optimism are that Britain is not at the global productivity frontier. We are somewhere behind it. You know, the fact that French output per hour worked is about 20-odd% or 25% higher, depending on which measure you prefer. The fact that German output per hour worked is a similar, slightly higher distance away, I think is grounds for optimism. You know, I said before, there was nothing in the water in Britain in 1850 which meant we were guaranteed to have this economic lead over Western Europe. There is nothing in the water now, sewage issues notwithstanding, there is nothing in the water now which means we are guaranteed to be much less productive than our peers. The space is there. Now, I think fundamentally, though, that is probably not just an economic problem in as much as it's a political economy problem. I think, you know, maybe this is also my grounds for optimism. You know, I thought when I finished writing that book in 2020, you know, I wrote about the rise of this post-economic motor that was insulated from the economic cycle. Now, what's happened in 2022 and looking at in 2023 is we had an inflation shock so severe that no one was insulated from the economic cycle. So maybe maybe even post-economic voters will now start to take the economy seriously. And maybe we can start to close that gap, which has opened up in the last 10, 15 years. Thank you.